Good morning, everyone, and a very warm welcome to all our guests who've joined us today from across the globe for yet another interesting webinar on market outlook, uncertainties in global markets, investment avenues, and gift city. I am Anis Ali, and I will be your host today. In our today's session, we will start with insights on market outlook and investment avenues, followed by a Q&A session and concluded with a brief presentation on gift city. So please stay tuned till the end for some interesting key takeaways and investment insights for making a more informed decision. So, to share his thoughts on this complex subject, we have with us today Mr. Sankaran Narain, ED and CIO at ICICI Prudential Asset Management Company, where he oversees assets of around 9.19 lakh crore rupees. Narain plays a pivotal role in shaping the investment strategies of the company and is a member on the Amphi Equity CIO committee. He is a market veteran with over 3.5 decades long career and has received several accolades and recognition for his contributions. So with this brief introduction, over to you, Narain sir.
Good morning to all of you. It's a pleasure talking to all of you out there. Uh, you know, the Indian market story actually started in 2013, 14. Between 2010 and 13, we had a lot of market uncertainty. Basically, India's current account deficit, inflation, fiscal deficit, everything had gone astray at that point of time. And consequently, we had a lot of challenges at that point of time in the economy. Slowly, what was done was that the entire economy was brought into control by actually increasing interest rates in 2013. And subsequently, starting 2014, there was a lot of effort made to keep the macro in very, very good shape. And I would say all the way from 2014 till now, the Indian macro has been very, very good. When we look at macro indicators, we look at fiscal deficit, we look at current account deficit, we look at inflation and growth. Of course, growth did have a setback during the period just after COVID. But overall, we look at these four indicators and think about how the macro has been. And I would say that the macro of India has been very, very good in this entire period. Now, despite this very good macro sitting outside India, many of you would be asking, rupee did depreciate significantly between 2011 and 13. And we have a situation in the recent past again where rupee has been depreciating. So why did it happen? Actually, the situation is very different. If you look at the period between 2011 and 13, we had a situation where current account deficit was very high. Whereas if you look at the period after 2021, even when the Ukraine-Russia war broke out and oil went up, we did not have a serious current account deficit problem. Why did we not have this problem? Primarily because of the fact that you had a very, very big increase in services export thanks to so many global capability centers being set up in India by most of the Fortune 500 companies from all over the world, whether it is US, whether it is Europe, or whether it is Canada, from all over the world, they have set up global capability centers, which resulted in a situation where the services export started booming. Because the services export started booming, despite the oil boom at that point of time, just after the Ukraine-Russia war, we did not have a big increase in current account deficit like 2011 to 13. So our current account deficit has been under control, and we have had a situation where the current account deficit has been very low compared to what we have seen historically in India. So why is the currency weak? The currency has been weak partly because of capital outflows. And why are the capital outflows in India high compared to what it used to be? Primarily because India has been in 2022 to 24 period. India was one of the costliest stock markets in the world. After NASDAQ in US, India turned out to be one of the costliest stock markets in the world. When that happened, we had a situation where many of the MNCs who had set up base in India over the last few decades, they decided, why don't we get listed in India and take out a part of the money that we have invested in India? So what happened was that we had a car company which listed in India and took out 10 to 15% of their stake in India. We had a consumer durable company which was the leader in the consumer durable space, listing in India and taking out 10 to 15% of their holding in India. Almost so many multinationals which actually used to get fully owned in India, they all started to reduce their equity weightage from 75% downward by selling their stake in India, because the Indian price to earnings ratio was higher than what they were getting in their home countries. In most of the time, the price to earnings ratio in India was double what they were getting in their home countries. They decided to cut their stake in Indian entities. All this resulted in a fair amount of capital outflows. Coupled with that, you have a situation, India is one of the few countries in the world where active equity investing has been happening over the years, not passive. Because you have an active equity investing culture in India, most of the private equity companies which invested all the way from 2015 till 2021, they could start selling their stakes in the equity market. They also started to take out the money and actually take out the money back to against their investment in India. So all that led to reasonable amount of capital outflows, and because of those capital outflows, we have seen a dollar appreciation, and India actually has had a depreciation against the dollar, even though there has been no big problem in current account. Added with the fact that India could not sign the trade deal with US, and actually we have a 50% tariff, and every day we wait for that India-US trade treaty, but it doesn't seem to be happening. But we have a situation where the just due to capital outflows we have seen this currency depreciate. Can this last forever? I don't think so, because against the capital outflows we have had a situation where in many of the sectors we have started to see capital inflows. For example, one Japanese bank is making a big investment in an NBFC, non-banking finance company as it is called in India. Another Japanese bank has taken a big stake in a bank in India. Another another Gulf bank has taken a big stake in a bank in India, and another NBFC, as also non-banking finance company, has been taken over. A big stake is being bought by a Japanese bank. So against many of these capital outflows, we have started to see big capital inflows in all these forms. And in recent times, we have also seen that many of the big American companies are also thinking of making big investments in data centers and all that in India. So against these capital outflows, we are going to see big amount of capital inflows also, which those announcements have been made, but many of those inflows are yet to take place. So we are going to see those capital inflows. And when we talk to the private equity people in India, they are all talking that we have actually got exits in India. So India is one of the best countries to invest in. So although they did take out the money for their own investment, they are likely to consider fresh investment in India. So what we really think is that the real effective exchange rate of India has become rupee has become most undervalued in the last 10 to 12 years. And we don't think that rupee can continue to depreciate on a consistent basis. And frankly, we don't even think of the fact that one of India's biggest investments over the last 3 centuries or 5 centuries has been gold, which is actually trading at an all-time high. So if you consider that investment, India must be having one of their best ever situation on a relative basis, because India must be having trillions of dollars of gold. Some people put it at $5 trillion, but no one knows that amount because it is not spread over 1% or 2%. It is spread over the entire 1,000 million people who own the gold. So we have a situation where actually Indian currency has become undervalued, and we believe that if we take a long-term view at this point of time, it is a currency to be invested in. And the best asset class to invest in at this point of time would be debt. or fixed deposit at this point of time, because while currency has become undervalued, we still have not seen a situation where equity has become cheap at this point of time. And for equity to become cheap, it may take some time. But definitely, currency has become undervalued. So, debt investment or a fixed deposit kind of investment has certainly become undervalued over a long period of time. So, what will happen to equity markets? Obviously, as you know, equity markets are very difficult to guess. But most of the time, India has been one of the costliest markets and it was best performing markets. But in the year 2025, it was one of the worst performing markets. Why was it the worst performing market? It was because in 2024 end, it had become one of the costliest markets in the world. And therefore, in 2025, it underperformed. And it is not seen as an artificial intelligence story. So neither do we make any of these NVIDIA kind of chips, or do we support the manufacture of NVIDIA kind of chips, like what Taiwan does or South Korea does. So we turned out to be one of the anti-AI players in 2025, which resulted in a situation where Indian market underperformed drastically in 2025. So by the end of 2025, India has become a contrarian market, and therefore India has become again a market where, like just like the rupee has become on real exchange, real effective exchange rate, one of the cheapest. Today we have one of the most underweight positions of foreign institutional investors at this point of time at the end of 2025 because of this AI boom. Now, do we have expertise to know what will happen to the AI boom? Answer is no, we don't have. I'm sure most of you who are listening to this call have more knowledge than me on artificial intelligence, stocks, and what will happen to that. But our view at this point of time is that Indian underperformance is unlikely to continue for the entire 2026. We believe that India is likely to do as well as the world, or maybe start doing better than the world in 2026. However, whether the Indian market gives absolute returns or not depends on what happens to artificial intelligence stocks all over the world. We believe that if artificial intelligence stocks continue to do very well, India can be a market performer, or it could be a slight underperformer. So in that case, you would get absolute returns, but it would be still an underperformer because India is still not part of the artificial intelligence story, unlikely to be. On the other hand, if India is likely to be, if artificial intelligence boom ends in stock market, I don't think it will ever end otherwise. But on the stock market, if it ends, India will be an outperformer. What kind of returns India will give at that point of time, I don't know. Whether it will give a negative big return or a small negative return or just stay flat, I have no idea. But in that case, we believe that India will be an outperformer. So we think that India will be an underperformer if artificial intelligence continues to do well, artificial intelligence stocks continue to do well, and India will be an outperformer if artificial intelligence stocks start to becoming underperformer. That's our view at this point of time. In either of these cases, I think the time to consider India on a relative basis has come. Whether it has come on an absolute basis, we are not clear at this point of time because Indian market is still not cheap at this point of time. That we can say that this is the time to invest in Indian equity because in our way of looking at valuation, Indian market has not yet become cheap. So from a macro angle, we are comfortable. From a rupee angle, we are comfortable. From a debt angle, we are comfortable. But from an equity market angle, the absolute valuation is not cheap. But since we are not linked to the AI cycle, and if you are very heavily invested in the AI stocks, if you want diversification, India is one of the best markets to consider at this point of time. So this is the kind of situation we are in at this point of time. So what are the risks at this point of time? The risks at this point of time clearly emanates from US AI stocks. US AI stocks are trading at very high valuations. The world's biggest investor, best investor for the last 5 decades, which is Warren Buffett, his highest level of cash at this point of time. So that kind of worries us that the quantum of cash that he's sitting on is very, very high at this point of time. So that worries us at this point of time. But the level of global valuations across the world the market cap to GDP in US has gone up to 200%, which is not a low number. We are not able to see value in equity markets anywhere in this world. And we have a situation where US fiscal deficit is high, and US trade policy is something which we are forced to look at every day in the form of new tweets. And the level of geopolitical tension between different players, whether it is China and Japan, China and US, is extremely complicated for any individual like us to actually determine on a daily basis. We are forced to look at tweets, look at different things to identify what is happening in the world. So overall, our view at this point of time is the global equity market does not have big margin of safety at this point of time. The risk reward trade-off in global equity market appears to be not safe at this point of time. Normally in these circumstances, one would go in search of gold, but unfortunately gold and silver are possibly more euphoric than most emerging markets at this point of time. So with the exception of the AI stocks, today gold and silver has become the most euphoric. So what happens in the long run, we don't know. In the short run, we don't know. But in the long run, when you invest in a euphoric asset class, normally you don't make money. The most euphoric asset class at this point of time seems to be silver, followed by gold, and gold to a lesser extent than silver at this point of time. So it has become a very, very tough asset class at this point of time to suggest what to do from our investment lens. Having spent a long time in financial services, in the financial markets, and managing other people's money, I believe this has become one of the toughest periods to decide what to do on asset allocation. Cash, maybe consider debt as a way to do it, and which currency to do it, that has also become a challenge. And clearly at this point of time, it is a very, very big challenge, because considering that the current account deficit, the fiscal deficit, and the net international investment position of the best currency in the world, called the US dollar, is not good at this point of time. So it has become one of the most complicated decisions at this point of time. And without a clear answer for anyone to actually handle at this point of time. So people have gone in search of gold, but that is also complicated. To sum up, we clearly think there is nothing to worry about rupee in the medium run. There is a clear case to consider the entire fixed income basket in India. We would be very happy to consider equity, but we think that equity market requires a correction globally, and at that point of time would be the best time to invest in Indian equity. But from an asset allocation point of view, if you are over-invested in US AI stocks, this is the best time to consider Indian equity, because Indian equity is a anti-US AI play. With that, I'm handing it who has some questions for me, I understand, from all of you, and we'll be happy to answer questions to the best of our knowledge and capabilities.
Thank you, sir, for this insightful presentation. I'm sure this information provides numerous opportunities for the NRIs to gain a comprehensive understanding of India's economic growth. Now, we will move to our Q&A session, where we have received questions from our customers. So we'll try and cover a few of them. First question is, how do current global uncertainties, geopolitical tensions, inflation, and interest rates shape the investment outlook for the next 12 to 18 months?
As I mentioned in my talk, it's extremely difficult, but we believe that there is a case to invest in Indian debt. There is a case to invest in some of the Asian currencies, because Asia is one of the highest current account surpluses in the world, and they have very good current account positions. So I would say those are some of the areas of hedge at this point of time. Globally, it is very difficult to find cheap equity markets at this point of time, and neither is gold and silver asset class, which at this point of time it looks easy to recommend, and it's become very complicated. So I would say Asian currencies and Indian debt are all very interesting areas to park money from a margin of safety point of view. Indian equities for a person over invested in US AI stocks is something to be considered.
Okay, sure. So the next question is, with US interest rates expected to remain higher for a longer, how should NRI investors in the US and Canada think about asset allocation?
Actually, it's very complicated in US because there is going to be a new Fed chief, and the president has been keeping on talking about the new Fed chief having to cut interest rates. If that were to happen, would the dollar be strong? Would the dollar be weak? Against which currency would it be weak? These are all questions for which there are no easy answers. In our view, in our framework of looking at investing, that is the reason we like current account surplus currencies as the best way to invest in debt at this point of time. We would love to invest in cheap stocks, but we are not able to find any cheap stock anywhere in the world at this point of time. So we are struggling.
Absolutely.
So that's why I would say Asian debt is one of the areas which definitely looks very interesting at this point of time. Because Asian currencies are really Asian economies have very good current account surpluses, and therefore, if US were to cut rates because of the new Fed chief, I think money will flow from US to Asian currencies. That's what looks logical at this point of time, and that is the way it looks like. But it's tough. So I'm giving you a view which can turn out to be wrong, but I'm using my poetic license given by ICICI Bank in this conversation to give my view.
Right. So we will take that, sir. We will keep Asian markets on our radar. Right. So the next question is, how should NRI investors balance investments between global markets and India in the current environment?
I think I've said it the third time. I think basically India has turned out to be an anti-AI trade. There are countries like Taiwan, Korea, US. These are all part of the pro-AI trade. So if you are over invested in AI, if you want to hedge your portfolio, the best way to do it is by investing in India in addition to that. On the other hand, if you're completely sold on the US AI trade, then you should continue with your current investments in US AI, Korea, and Taiwan, because these are the countries which are completely linked to the US AI trade. Given my years of investing, our belief is that the US AI stocks are all fully valued, and anything connected to AI seems to be fully valued and doesn't appear to have margin of safety in the framework that we look at. Can we go wrong? We can go wrong, but this is the framework that we have used in our investing framework. And that framework suggests that the margin of safety in US AI plus Taiwan plus Korea AI stocks looks fully valued at this point of time. I
Okay.
want to reiterate that I'm not an expert on US AI stocks.
No, but we take your views for it, sir. So the next question is, given the currency fluctuations, how important is timing and currency planning for NRIs remitting funds to India?
I think in history it has proved to be important, but one way of people thinking is that in the last 50 years continuously dollar has appreciated against rupee. But if you look at it the other way, 2011 to 13 was a period where rupee depreciated a lot. But after 2013, there has been a period where rupee has not depreciated a lot. So in our view, today, after this depreciation which has happened against, rupee has depreciated against dollar. We are of the opinion that rupee has become an attractive currency, because rupee has depreciated for reasons which are not normal. And we believe that if by chance there is an India-US trade treaty, rupee should appreciate reasonably well. And that is why we think that rupee has become a very interesting currency at this point of time to actually consider. And, in our years of looking at markets, we would have never said this before. And it is not as if India does not have foreign currency reserves. If you look at India's foreign currency reserves plus the quantum of gold that Indians have, it would be just stupendous at this point of time. If you mark to market the gold that Indians have today, and that should be considered because gold has been such a phenomenal performer at this point of time. I think Indian currency on a terms of trade basis, you have a situation where oil has come down. Indian services export has been zooming, and gold has gone up, and India's trade deficit is not high. The combination suggests that rupee has become an undervalued asset class.
Great. So the next question, Naren sir, is which sectors or themes globally and in India look relatively resilient amid ongoing economic certainty? And is Gift City a good option for investment diversification?
I think Gift City is a great opportunity for investment diversification. I'm not fully aware of the laws and the rules applicable for citizens outside India, and I think ICICI Bank is organizing a conversation just after my talk, and I think you should listen to that conversation. I'm not an expert on the rules thereof, but I think it's a very interesting area, and the rules thereof has been continuously created by the government of India to make it easier for NRIs and other people to invest. So I would say that you should take this conversation where what my colleague will be speaking on from ICICI Bank. The first part of the question was, sorry, I just missed it.
Which sectors or themes globally and in India look relatively resilient?
I'm a believer that if there are stocks with very good free cash flow yield, with good balance sheets, and where the valuations are more reasonable, I would say that if particularly if you have a US tech oriented portfolio, which you already have, then I think you can add to that kind of portfolio. I'm assuming that almost everyone in the last decade has slowly moved to a US tech oriented portfolio because the nature of the boom has been so intense, so large, and so big that almost everyone has ended up with a US tech oriented portfolio. Because anyone who has a big investment, even in the index funds like S&P or NASDAQ, ends up having a very US tech oriented portfolio. So I'm saying against when you have that as your main portfolio, our view would be to, along with that, have a high free cash flow, low valuation, financially very strong companies in addition to that. Not that some of the tech companies aren't, but then they are not that cheap. That is what I would say. As I mentioned, India is an interesting addition, but India is not likely to give absolute returns in a big market correction. I am not a believer that India can stay immune to a fall in a big market correction. Although India is an anti-AI trade, I don't think India can give capital protection in a big market correction. That is our belief.
Got it, sir. Got it. So we'll just take one last question, sir, before we move to the next session. So the last question is, what key indicators should investors track regularly to understand the shifts in global and Indian markets? Kind of, we are
I think
asking you for cues.
sitting in US, I believe that the area to look at is to watch what is happening to US yields and what is happening to dollar. And if the dollar index were to fall precipitously, I think that would be the biggest risk, I would say. I think if dollar index does not fall precipitously and US yields are well behaved as they have been in the recent past, I think it means that the system is fine. But I would say that the current global valuation in equity across all markets does not lend itself to taking leverage at this point of time. That is how we think. But then we are basically, we are mutual fund investors, and we always recommend caution because that is the way in which we have been trained to inform investors. But the more risk people have taken globally, the more money they would have made in the last 5 years, particularly in US technology stocks. So, what I'm trying to tell people today in this call is actually moderate risk, because I think by taking risk, people have actually made good amount of money. So thank you for the opportunity, and I'm very happy that you're now going to hear Mr. Sudip talk about Gift City and what can be done by NRIs at using Gift City. So I would request Sudip to talk about it. And thank you, ICICI Bank, for giving me this opportunity to talk to all the NRI customers of ICICI Bank. Thank you.
Great. Thank you. Thank you once again, Naren sir, for sharing your thoughts with us. This was quite insightful. Thank you.
Thank you.
All right. So now I will invite Mr. Sudeep Ghosh from our Gift City business team to give us a brief understanding on the features and benefits of Gift City. So over to you, Sudeep.
Yeah, thank you, Anisali, for the introduction. Good morning to all our valued guests joining from the United States. So I am Sudeep Ghosh from ICICI Bank Gift City, and I'm responsible for personal banking, that is retail segment. So thank you for taking the time to connect with us. It is a privilege to interact with customers across geographies, and we are excited to share how ICICI Bank Gift City can support your international financial needs. So Gift City, Gujarat International Financial Tech City, it called. So India's first international financial services centers. The vision behind Gift City is to create a global competitive financial and technology hub supported by world-class infrastructure, attractive tax incentives, and a progressive regulatory framework. Gift City spread across 886 acres of land, where one third is called as foreign location or special economic zone, financial special economic zone. So in our country, there are more than 280 special economic zones, mainly for manufacturing and IT industries. So this is India's first financial special economic zone. And remaining two-third being the domestic tariff area, it treat like same other part of the country. It is also power of sectoral regulators, power of four sectoral regulators, namely RBI, SEBI, IRDA, and PFRDA, has been vested with a single regulator called IFSCA, International Financial Services Centers Authority. So under IFSCA, GIFT City is the first center as of now, and many more to come in future. So ICICI Bank is among the pioneer financial institution in at GIFT City. So through ICICI Bank GIFT City, what we offer? So we offer foreign currency savings account in 8 global foreign currencies, mainly USD, GBP, Euro, and Canadian dollar. It is interest bearing account. Nomination facility is also added for convenience and security. We also offer foreign currency fixed deposit with a flexibility ranging from 7 days to 39 months. So you get a short-term liquidity option in India from now. So earlier we have FCNR. So we have FCNR with India team, but short-term liquidity, which is less than 1 year, was not there. Now with that, with GIFT City, you have that option also. Also, we offer for liquidity concern, we offer foreign currency loan against deposits. It can be availed against your NRE fixed deposit, which is in INR. Also, it can be taken against your FCNR in India and against GIFT City fixed deposits. These propositions are designed to provide NR customers with global access, flexibility, and efficient cross-border financial solution. These all the options are available for NRIs, OCIs, and PIO. So that's it from my end. Initially, over to you. for any Q&A.
All right. Thanks, Sudeep, for sharing this information with us. Before we take two or three questions around this topic, I will request our viewers to share your valuable feedback on the link shown on your screen. Okay. So, Sudeep, we have, I think, just two questions for you. Now,
Yeah.
first one being, what are the charges for opening a Gift City account?
Yeah. So there is no charges. So Gift City accounts are like there is no charges in opening Gift City account, and also as of now there is no minimum balance criteria as well. The only charge we take is outward remittance charge. So anyone is transferring funds from Gift City to overseas or Gift City to their India account, we charge flat 10 units per transaction, irrespective of the amount. That is the only charge we take. For account opening, there is no charge.
Okay, so there are no charges for opening an account. There are no minimum balances currently
Yes.
that the customer needs to maintain. Excellent. And what is the process of opening a Gift City account?
So for existing NRI customers, we have already live digital process. So customer can log in into their internet banking of NRI account and they can process. It's a DIY journey and it can be done within 5 minutes.
Okay, and in case, so can I just digitally and we can also visit and do it physically, right?
Right. So physical process also there. Customers come down to branch and they wants to open Gift City account. So they can open it physical mode also and also digitally.
Excellent. I think that is a great, opportunity for all our NRI customers. And so thank you, Sudeep, for taking out time and speaking to all our customers and giving us insights on Gift City. This is really quite insightful. So thank
Thank
you
you,
all
Vanisali,
for
for the
being
time.
part
Yeah.
of this discussion and giving your valuable time to us. We hope you found the insights valuable, and we look forward to seeing with you again soon. Until then, please take care, stay safe, and bank on us. Thank you.